Well, thank you guys so much. I feel like it's been a while since we've been here doing a CPA Academy webinar, but we are back and we are excited to talk about state and local tax and really dig into refund reviews because, as we know, or as you're about to find out, they are more important today than they ever have been. So many of you know me. I'm Maggie Crowley, Head of Strategic Development here at Layton. My passion is partnerships, and that's also my role at Layton. I manage our CPA partnerships. And then please welcome Brian S. He is our practice lead for state and local tax. And Brian brings with him 14 years working for some big four firms and most recently building out the SALT practice at a tax firm. And Brian, please elaborate on yourself.
Yeah.
I don't know if I'm doing it justice.
Yeah, thanks, Maggie. So as Maggie said, I spent about 10 or 12 years at big four top 10 firms and then built a SALT practice at a mid-sized firm in Arizona. I wanted to give a special thanks to Autumn. Autumn, I can tell you've done this a time or two. Your presentation voice is great. So thanks for setting it up. I also have Tyson over my left shoulder here. So if he is playing with this toy, hopefully don't mind him too much. But here's our pretty faces again. Thanks for everybody for being here. Maggie, was there anything else you wanted to chime in on before we get going?
No, I think we can run through the agenda and then get into the show.
All right. Yeah, and I didn't hear anybody from Milwaukee, but I'm sitting here in Arizona and our Diamondbacks swept the Brewers last night, so hopefully there's not too many people mad at me or mad at Arizona, and you can put up with us for for an hour. So Maggie's in Boston, but we have as like a lot of businesses do, people everywhere right now. So happy to be here. All right.
Yeah, we saw someone from Mashpee. That's close to Boston.
Yeah. Okay, so our agenda for today, obviously our topic is SALT and why it's so important in refund reviews. So we're going to talk about all things SALT, sales tax, where does Wayfair stand now, what is Nexus, what can we do about Wayfair, and what should we do about it. Exemption certificates gets brought up a lot by clients and firms trying to figure out how those work, so we'll touch on that. Drop shipping is a big thing, especially nowadays. Notices and state audits, what to do about it. And then kind of our favorite thing to do is refund reviews. They're also referred to as reverse audits. I try not to use that A word if I don't have to. I think refund reviews sounds a lot nicer, more pleasant on the ear. So we're going to call them refund reviews today. But we really like those, and why why that can save you or your clients a bunch of money and get money back. So talk about that for a while. Due diligence, and then we kind of move into another prong in the SALT world, which is income and business tax. Go over those and sourcing and how income tax differs and how it's the same as sales tax. And then we'll briefly touch on kind of the last two prongs that I like to talk about: credits and incentives and property tax, how those affect your business, and what to do about them. So with that being said, we will jump into
our first polling question now.
Oh yes,
we have our first polling question.
So
all right, everyone, what is your level of knowledge in SALT services? What's SALT again? I provide some SALT tax consulting services. You're an expert, or you're here to learn how SALT affects your business. The poll is open, so get your votes in.
All right, as she mentioned, poll number 1 is live on your screen. As a reminder, we'll have 4 during the presentation, and you need to answer at least 3 of them to earn full credit. However, I do suggest answering all 4 just to be sure, and we'll leave them open for a minute to make sure everyone has an opportunity to vote. We just have about almost everyone in, 93%. Getting ready to close this one down in 3, 2, and 1. I'll quickly share those results so y'all can see that. It looks like 49% led with "I'm here to learn how SALT affects my business." followed by a close tie between what is salt again, and I provide some salt tax consulting services.
Okay. All right. Maybe I should go back a couple slides and define salt, huh? No, I'm happy. I'm happy that we're going to be able to tackle some of those answers for you. Talk about what salt really covers, which of course is state and local tax. And then we've got some salt experts on here, so hopefully this is just a nice review. And then happy to answer any questions about how salt affects your business. So thank you, Francis. Yeah, go ahead, Maggie.
Before you start, Brian, if you guys don't mind, just throw your questions into the chat box, and I'll monitor them throughout the presentation and get ones answered that we can during the presentation. Otherwise, we will personally answer them and send them to you guys after the presentation today. Thank you.
Perfect. All right. Let's see. So sales tax, kind of the first prong of state and local tax that we like to talk about. A lot of people are familiar with sales tax, right? So for starters, 45 states and the District of Columbia have some sort of sales tax system set up. The nomad states, as they're called, do not have that. So that's New Hampshire, Oregon, Maine, Alaska, and Delaware, with the caveat, and you'll be hearing that word a lot today, because within the sales tax world, of course, every state has their own setup and rules. So there's going to be a lot of caveats, or generally speaking, or exception to the rules. So get used to that. But nomad states do not have it, with the caveat that Alaska does have some local jurisdictions taxing or enforcing sales tax. So something to keep in mind if you have sales tax going on. Hawaii, New Mexico, South Dakota, West Virginia, there are a few states that charge on almost everything. So typically we think if you're selling some sort of project, some sort of property, like a widget or a shirt or whatever, what have you, that's going to be charged sales tax. Most of the time, again, generally speaking, services are not going to be subject to sales tax, but there are a few states that charge tax on everything. So that's stuff from even CPA, services, or something as crazy as that. So something to keep an eye out for if you are doing business in those 4 states. And then sales tax is only intended to be charged once. So this is a little bit different from, we have offices in Canada or overseas, and so they have a value add tax or the VAT tax system where a little bit of tax is charged kind of every step of the way, right? You have a manufacturer who makes something and sells it to a retailer who turns around and sells it to Brian S. And a little bit of tax is charged every step of the way. In America, sales tax is only intended to be charged once. So most people are familiar with the resale certificate, meaning if the manufacturer, in my example, sells to a retailer, the retailer can give an exemption certificate to the manufacturer and then only charge tax to me that I pay. So we'll get into that a little bit more. If you're not familiar with it, no problem. But of course, we're all used to going to Walmart or whatnot and paying sales tax on stuff we buy. So it's only intended to be charged once, and then it is not PL 86272 protected. So I'm going to put this on the back burner for now. It's going to come forward a little bit later, but we'll talk about that. Don't want to spoil any surprises. So Wayfair and economic nexus, right? So the way of the world, or I should say the way of America, prior to 2018 was that you did not need to worry about sales tax unless you had some sort of physical presence in the state. In 2018, June 2018, the Supreme Court of the United States basically said, more or less, hey, it's the 21st century. Everybody's selling over the internet. We have ways to track that now. We have the technology to track it now. So if you have a certain amount of sales into a state, that we're gonna allow states to enforce the sales tax on your sales. So that is what Wayfair is, and the case was the business Wayfair, the online website, took it all the way to the Supreme Court. So that's why it's referred to as the Wayfair case. So all 46 states, so all 45 states and then, of course, in DC, now have some sort of rule in place. Missouri started earlier this year. The typical thresholds for that, right? So they don't say if you have $1 of sales there, you need to collect sales tax. They have some sort of threshold in place. The typical threshold is this $100,000 or 200 separate transactions into a state before you need to start worrying about collecting sales tax. Again, generally speaking, it's 100,000 or 200 transactions. We of course have states like Texas or California that have 500,000. Some states in the Southeast, like Alabama, that has 250,000. So something to keep in mind. They're all a little bit different. I told you I'd be saying that a lot. And then what is included in the threshold, right? So some states say we only care about your taxable sales. If you're selling those widgets, that goes towards your threshold. But if you're selling some sort of services, or if the manufacturer is selling those widgets to a retailer, and they should be exempt through this resale, we're not going to worry about it. Of course, other states say we are worried about it. If you have $100,000 worth of sales that are exempt or not taxable, that $1, the next dollar that you sell is going to be taxable. So it's not so cut and dry as saying, oh, I have $100,000 worth of sales there, I need to worry about sales tax, or I'm a wholesaler, I don't need to worry about sales tax. There's a little bit of a mixture. So something to keep your eye on as your clients or you guys are selling across state lines. And then marketplace facilitators. So this is commonly referred to as your Amazons, your eBays, your Etsy's of the world, that is providing some sort of marketplace to allow buyers and sellers to come together. And so what happened shortly after the Wayfair case was state said, okay, instead of going after all the moms and pops or all the different businesses that sell through Amazon, we're just going to make the enforce Amazon to collect the sales tax on all their sales on our website. And so again, something to consider when looking at the thresholds. Are our marketplace facilitator sales included in that threshold or not? One other thing to keep in mind with this is that it did not replace the physical presence nexus. So I started the slide by saying the way of America was that if you didn't have physical presence, you didn't need to worry about it. That's still something to consider. So if you have some sort of physical presence in a state, that's employees there, independent contractors, property, inventory. If you have any sort of physical presence in that state, you need to worry about your first dollar of sale. So there's no minimum threshold for physical presence. I put real world, real scary, because the real world can be real scary sometimes, right? Delivery, rental. So if you are delivering on your own trucks instead of common carrier through UPS or whatnot, if you have your own trucks going into the state to make your deliveries, that's going to give you physical presence. Then you need to worry about sales tax. Same thing about rentals. You may be renting your equipment out to businesses in other states that is still owned by you, and so therefore you have a physical presence in that state. And then one of the scariest situations is these Amazon warehouses, right? So fulfillment by Amazon, FBA is big. We've had clients that say, I do all my sales through Amazon, and of course they sit in an Amazon warehouse, but I don't know if it's a California warehouse or a different warehouse. And so theoretically, technically, you have a physical presence there, and a lot of states will say you should be responsible for collecting sales tax on your sales to that state. We'll talk about that a little bit here in a second, but yeah, something to keep in mind. There's a lot of factors in this. Okay, let's see. So sales tax, 5-step approach. We did have I had some sort of graph here earlier. It was pretty, but it was kind of confusing and didn't give as much information. So we kind of replaced it with this. Hopefully it's very easy to follow, the 5-step approach to sales and use tax compliance. So I've heard about Wayfair, you've heard about physical presence. Then it's, what do I need to do about it, right? So here's your 1, 2, 3, 4, 5. So step 1 is figuring out whether you have nexus or not. By the way, nexus is just a legal jargon or a fancy word for significant connection. Again, oversimplifying it, the Constitution of America, the United States says, states cannot enforce some sort of sales tax unless you have the significant connection with the state. Again, that's oversimplifying it. So for those 6% of salt experts, don't come at me. But yeah, I think that is in the preamble, right? We the people will not tax unless there is nexus. So anyway, step 1, nexus determination. Where do we have physical or economic presence? Lay it out. Look at all the states. Figure out where you have that threshold met for economic purposes, or where you have independent contractors, employees, etc., and determine where you have nexus. Step 2 would be to ask, is what we're selling or buying even taxable? So that kind of goes back to our manufacturer example. Well, we have people here, or we have a ton of sales here, but what we're selling is exempt for resale, and this state doesn't count that towards the threshold, so therefore we're not worried about it. I do put a note in there. So there is a difference between non-taxable and exempt. Non-taxable sales would be, for instance, some sort of service I provide you, that state doesn't tax that service. That is a non-taxable sale. Exempt sales are, I sold you this widget, but you're going to turn around and resell it, and it shouldn't be taxed as long as that exemption certificate is presented. We'll talk about that in the exemption certificate section, but just note that there is a difference, and it does come into play with this approach, with determining nexus and whatnot. All right, so A, we have nexus. B, what we do is taxable. Then is to figure out what is our outstanding liability, right? Have we had an employee there for the last 10 years and we should have been collecting sales tax for 10 years? Or we have no physical presence there. We just reached economic nexus last month. We're probably not going to have that much outstanding liability. And that comes into play for step 4 here, which is mitigation and disclosure. So yes, we have nexus. Yes, what we're doing is taxable, and we have a ton of taxability, outstanding liability, right? We've been doing this for 10 years. We've never collected tax. What should we do about it? We recommend, or I work with the clients, I should say, a lot to do what they call a voluntary disclosure or a VDA. And there's 5 benefits listed out here, but it can be really helpful for clients. So typically the process, again, simplified, is that we take our client's information, we work with them, we go to the state and say, hey, state, we have a client who just realized that they had nexus, or they didn't realize what they were doing was taxable, something like that. They would like to come forward and wash their hands of this mess and do right by you, so to speak. So we do that anonymously for most states, again, generally speaking. And then we get into agreement that allows for these other benefits, which is it limits the look back. Generally speaking, the look back is limited to 3 to 4 years. So if you've had physical presence there for 10 years, you've never collected any sales tax, this voluntary disclosure is going to allow it to only be 3 or 4 years. So you can see right off the bat how that would really, really help. It's going to lower interest, and that's a kind of a byproduct of the limited look back. So this is a compounding interest. And so the shorter the look back period, of course, the lower the interest is going to be that is due. And then it eliminates penalties altogether. So boom, if you're getting audited, it's going to be penalties and lots of interest. Texas comes up a lot. Obviously, there's a lot of people there, so I think a lot of people sell into Texas. Fortunately, fun fact, they get rid of both interest and penalties. So double whammy, very, very exciting stuff. And then the last benefit there is that it's a taxpayer-driven process. So this doesn't really show up on a balance sheet or whatnot, but again, trying to simplify this for everybody, the process is more or less saying, hey, we'd like to enter your voluntary disclosure agreement. And by the way, here are the sales we've made over the last 3 to 4 years, and here's the tax we owe you. Boom, that's it. Of course, if you didn't initiate the process and the state came after you for an audit, they might send somebody to your office to look through stuff. They're going to go through invoices. They are going to ask for all your balance sheets and trial balances, everything that you can think of. They're going to start asking for it. So it's going to take a lot of time out of your day or your accountant's day, CPA's day, all of that. So it's a lot of saving of headache, not necessarily on the balance sheet, but so that's really exciting too. Okay, so what happens if I don't have that much liability, right? I just passed the economic standard next month. Do I have to go through this voluntary disclosure process? No, typically not. We can just register with the state going forward and start collecting sales tax and filing either your monthly or quarterly return, depending on the state. And so that's kind of step 5, right? So once we're set up, yes, we have nexus. Yes, we're doing taxable stuff or not. We don't have much exposure, or we do a VDA. Now you're registered with the state. Now you need to collect. So collecting sales tax depends on kind of what your business is or your client's business is, right? If they are selling to 5 clients across 3 states, it's not too hard to figure out what the sales tax rate is going to be. If you are a e-commerce business and you're selling to individuals all across the country, it's going to be impossible for you to figure out the sales tax rate, especially when there's sales tax holidays and these rates change quarterly or whatnot. So look into a software business that can do that. The reporting side of it doesn't need to also be with a software business. It can be with your CPA or internal. that's your 5-step approach to becoming compliant and what we like to say audit-proof, right? So follow those steps and you'll be good to go. Okay, so here is a case study just to give you a quick example. This was a retail business, had about $15 million of revenue year over year. They were growing, which is exciting, and they didn't have, I think they had an accountant that left. I'm trying to remember this particular example, but they had an accountant that left. They were looking to sell their business, which is one of the questions we always like to ask our clients. What is your exit strategy? Of course, we have clients that have, the business. So we're the 6th generation to own this. They're probably not looking to sell their business, but we have other clients, right, that have created a SaaS company or something like that, and they are looking to get bought out. This will come up in due diligence, absolutely. So we'll talk about that here in a few slides, but preparing for an acquisition, that's one of the reasons to go through a SALT study or a Nexus study. So we just put in there date signed and Nexus study delivered, just to show that it should be done fairly quickly and that you can cover all 50 states. And then through that process, we identified there, you can see at the bottom, 6 states that we recommended doing a VDA. And because of the limited look back period and get rid of the penalties and lowering the interest, we were able to save the client $168K. So it can be a really powerful thing. And so it's not, we have other services, right, that are R&D credits, and ERC was big bang, and it's a lot of times it's, oh, well, they're able to quickly give me some, well, I shouldn't say quickly, but they are able to get some money back, and we don't pay our advisor until we get paid, all that stuff. But this stuff will come back to bite you in the butt if you're not handling it. But the point is, we can save you a lot of money by doing it, or your CPA, I should say. So very important stuff. A couple quick notes here. So no duty to collect, register, and file unless a nexus exists, right? So you could have $99,000 worth of sales with no physical presence. You do not have to worry about collecting and filing those returns. And then, of course, if duty does exist, you need to have a plan in place, which is what we talked about. So that's just what that slide is trying to demonstrate. Okay, some new tidbits on the sales tax world. Retail delivery fees. This started in Colorado, was it last summer or 2 summers ago, but they said, hey, on everything that's delivered to Colorado, as you can see, they're all items delivered to Colorado, 27 cents needs to be on the invoice as a retail delivery fee. Doesn't matter who owns the vehicle, where it originated from, right? If you're shipping from out of state, doesn't matter if it's common carrier, you need to charge this and send it to Colorado. New York City, Minnesota's jumped on board. There's probably some more states, that are lining up to do so as well. This will be interesting, right? It kind of creates more of a headache for you or your clients that are selling into these states, something to keep an eye on. So be aware of that. Sales tax is always changing. Mississippi earlier this year got rid of their SaaS tax, right? Software as a service. They no longer tax that. They historically did. Oregon implemented a commercial activity tax, and then Oklahoma redacted the franchise tax recently. So this is not something that says, hey, we charge tax on SaaS, the end. We charge an 8% rate, the end. This is always changing. So it's something that you need to kind of review or stay abreast of year over year. Fulfillment by Amazon, touched on that earlier, but Pennsylvania came out and said, hey, we're not going to worry about it if you're storing stuff with Amazon, which I think all states should do that, right? If you're selling through Amazon, you don't know where it's at. It's kind of unfair, but currently it is taxed, or excuse me, it does create a physical presence in California. So again, something to keep an eye on. And then mobile workforce exceptions lapse. This is not new news, right? But it's just something to keep in mind when it comes to Nexus, right? Because now we have employees everywhere, all across the country, and it creates that physical presence with no de minimis protection that I mentioned earlier. So if you have an employee or an independent contractor that's working for you, and you have $1 of sales there, you need to be technically worried about collecting sales tax on that. Oh, I went the wrong way. Okay, so sales tax exemption certificates. Thank you. Okay, so we have a bunch of clients who are saying, hey, I don't need to worry about sales tax. We are a wholesaler or whatnot. How do we answer that? Is that the right answer? Yes and no. The way that exemption certificates work is whatever you're buying should be exempt if the proper documentation is presented at the time of sale. So a couple different hoops you need to jump through there, right? So we have clients who haven't been collecting exemption certificates. Best practice, always get them. The worst case scenario, and you hear about this in the news, maybe you probably don't hear about it in the news. I hear about it in the news because I read SALT articles for fun, but about a dozen times a year, you'll hear that manufacturing or a reseller, whomever gets audited, and the auditor says, hey, why aren't you collecting sales tax from your sales? And the manufacturer says, well, we're a wholesaler. We don't need to worry about collecting sales tax from whom we're selling it to. And the auditor says, that's fantastic. Can you prove it? And then you're kind of stuck, right? When you don't have the documentation to prove it. Some states will give you about a 90-day window or a 60-day window to get those. But like I said, you hear it about a dozen times a year. An auditor woke up on the wrong side of the bed. There was one out of Rhode Island not too long ago, and they got assessed about $400 grand because they didn't have the proper documentation at the time of sale. So just because you are selling exempt doesn't mean you don't need to worry about anything. You still need to get these exemption certificates. So not only at the time of the sale, best practice is making sure that they are executed, that they are the correct form, right? So there are, again, generally speaking, states have different exemption certificates for a resale, or if you are a manufacturing company and buying something that is going to be put into your manufacturing process, or if you are a contractor and using that, there are different forms. You need to be aware of it. Of course, if you use the wrong one, you don't want that auditor waking up on the wrong side of the bed that I talked about. And then the last thing to keep in mind is which state, right? So all states have different ones. 10 states don't accept out-of-state resale certificates. I'll talk about the options there in a second. I'll jump back to the slide when we talk about drop shipping here in a minute. So I'm going to move forward from the slide, so I'll get back to that in a second. But point of this slide is to make sure that you get the proper documentation at the time of sale. So here is the dropship model that I referenced. Obviously, you know, I'm sure I buy stuff online all the time, and it is dropshipped to me without me even realizing it. Right, so I went to buy a new golf polo. We play a lot of golf here in Arizona, and I order it from a company online and say, hey, I want to buy your shirt, right? That's the store. And then they say to their manufacturer, hey, instead of shipping it to me and then turning around and I'm shipping it to Brian, just go ahead and ship it to Brian. And you know, that's how the drop shipping model works, right? So if you're not familiar with it, it's pretty common. And this is how it looks. The questions that arise here are who is subject to collecting sales tax, who should be paying that sales tax, who should be giving exemption certificates, right? So I put this into the slide because into this presentation because it does come up a surprising amount. And here are the quick rules for it. So if the retailer, we'll call them ABC Corp, ABC Shirt Company. If ABC Shirt Company has Nexus where Brian is, then great. The retailer would charge me the sales tax on the sale, right? Easy enough. Let's move on to number 2. If retailer does not have Nexus in Arizona, but the drop shipper, maybe the retailer is based out of Chicago and the drop shipper is from California. They do a lot of business in California, or they have employees here, so they have Nexus, but the retailer, the shirt company in Illinois, does not have Nexus. Well, then the drop shipper can charge the retailer sales tax in the Arizona state because that's where the product is delivered. We'll get back to that in a second. Number 3 is, of course, if neither one has Nexus, then neither of them have to worry about collecting, right? That was one of the earlier slides. Then the onus is on the buyer to pay use tax, right? So technically, I have shipped that to Arizona. I haven't paid sales tax on it. It is a taxable product. I should be reporting to the state that I have use tax, right? So we'll see this on obviously, I don't think the state of Arizona is going to come after me if I don't pay sales tax on a t-shirt, but if you have big businesses that are doing this type of stuff, it's something to keep in mind. So the real issue comes into play is number 2, right? So retailer doesn't have Nexus, but dropshipper does. The dropshipper should be taxing the retailer. They have a couple options. Flashback. the retailer can register, right? So they don't have to pay the sales tax. They can use a resale certificate because that's what they're doing. So they can register in Arizona to get a resale certificate, give that to the drop shipper, say, don't tax me, we'll just tax the buyer. But of course, that comes with responsibilities. That is quarterly or monthly filings for sales tax, paying nominal fees, any of that, worrying about all the future sales that you do into Arizona, right? So it's not just this one, it's any future ones now that you're registered and set up there. Or you can just pay sales tax and turn around and collect it. So this is where it comes into the bottom line of this slide. Most states, again, generally speaking, will allow you to use your home state certificate. So Arizona might say, or the retailer, the shirt company in Illinois would say, hey, I don't have an Arizona resale certificate, but here's my Illinois resale certificate. So don't charge me tax, I'll charge the customer tax. And it usually works out just fine. There are 10 states there, as you can see, that don't accept out-of-state certificates. So that's where you're saying, oh, you either need to pay the sales tax or you need to register to get a resale certificate. So that's the quick and dirty on the drop shipping. Again, this can get real confusing real quick, especially if you have multiple manufacturers or multiple retailers that are selling to each other down the line. They're all located in different places. So shoot your questions. We'll get back to them after the webinar if you have specific dropship model questions. Okay, Maggie.
Another polling question. All right, guys. I am or have clients that are currently under some sort of state audit or have recently received a notice. One's easy, true or false. You got two options. You got to pick one. The polls are open.
Poll number 2 is live on your screen. We'll give it about another 30 seconds here. All right, y'all are voting in fast. Thank you so much, 91%. And getting ready to close this one down in 3, 2, and 1. 76 said false.
Wow. I think we've kind of seen an uptick in the states going after people for any violations after COVID. They're hungry for a way to collect some cash.
Yeah, absolutely. Well, that's great. 76%. So let's keep it that way, right? Or maybe some of those 76% are like, oh no, let's become audit proof, right? So let's talk about a little bit of notices and audits. So notices, I mean, they can come by different names, right? Questionnaires or something else, but this is not quote unquote an audit yet. There perhaps is still time for corrective action. So I've had clients that got a notice and we immediately said, let's file for a VDA. Again, I don't want to overpromise, but that might be an option. Or reaching out to the state and say, hey, look, this notice gave us reason to come to you and let's start negotiating those terms of payment or what we might be liable for upfront so that we can kind of meet the notice or upcoming audit head on and get ahead of it. I do have clients that ask a lot, hey, why would a notice come my way, right? So I'm, let's say, using my example from earlier, it's an Illinois company, they're selling into Arizona, and they're like, hey, we have no physical presence there. We sell some stuff there, but how in the world would we get a notice or get an audit from a different state that's halfway across the country? The reason is typically it comes from audits of either your vendor or your wholesaler or your customer, right? So I don't think, again, the state's got to audit me, but perhaps you're buying from the wholesaler in California that I talked about before. They are under an audit. Again, those audits, they're going to look at invoices or any other accounts payable and see ABC Shirt Company in Illinois. Then they say, hey, it looks like the shirt company is not set up in California. Why aren't they? Are they filing here? And so they send out that notice to try and get some information from you. So just because you don't have some sort of physical presence there doesn't mean that you are completely under the radar, right? And then audits. I like to tell clients, look, we can, in fact, push back somewhat nicely We want to make sure those if there's any auditors in the call, we respect you and we value your input. But a lot of times they come with asking for everything under the sun, right? They want to see anything that you've ever done, anything that you've ever prepared, all of that, anything you've ever purchased or sold and whatnot. So they might say, hey, we're doing an audit on your sales tax. And then they start asking for old income tax returns or something that maybe doesn't play into what they're looking at. And so we kind of push back. Or they want to audit, hey, we're going to look at the last 40 years. Please send us everything from the last 40 years. And so we will say, all right, look, it's going to be so much work for us. How about you pick 1 month out of each of those 4 years, and we'll pull the information from those months, right? So there's some stuff you can do with those. And then I want to also make sure that the clients know that states are not looking to bankrupt your business. So I have had some clients that said, hey, I got this audit, supposedly I owe, 100 grand, and business has been tinkering down, and if I have to pay 100 grand right now, I'm going to be out of business. That's not what states want, right? So if you go into bankruptcy proceedings, they might get cents on the dollar, and then of course they're not going to get your tax revenue going forward. So what we can do is settle perhaps for a lower amount, or we can work out some sort of payment plan. So usually they'll say, hey, don't pay us 100 grand right now, pay us 25 grand over the next 4 years. Work something out with the state, with the client, because they don't want you to go out of business. And within audits, again, it's not the end all be all, right? So if you are selling a widget into a state and you have physical presence there, and widgets are taxable in that state, of course, then it's going to be harder to argue or make a case about your situation at hand. But there are other times where the law is not so cut and dry, right? So we had a client who was selling IV drips, the hangover drips, right? And some like Botox fillers and whatnot. And the law seemed a little gray, right? So we made an argument back and forth. And of course, the auditor, who a lot of times at first is a auditor who's just come out of schooling, they want to impress their boss, they're throwing stuff at the wall, seeing what sticks. And so they're pushing back and forth. And so it got to the point where I told the client, like, we need to either, work out a payment plan, or we can take this to court. And client said, all right, let's take it to court. And so we submitted that request. And about a week later, I got a call from one of the senior auditors that said, hey, don't worry about it. And so, it is time and money out of the state's budget as well to have these auditors working these cases. So they might not want to take it all the way to court too. So it's a little bit of a song and dance. Again, they're not trying to disrespect anybody or anything like that. It's just, making a persuasive argument for your business or your client's business. And then as Maggie mentioned there, 25%, Maggie, maybe, maybe it would have been 10% if we asked 5 years ago, right? A lot of states pulled back on their audits during the COVID years. They didn't want to come to your office for distancing reasons, or, they wanted to give businesses space to make sure they got through the COVID years. Not to say COVID doesn't still exist, but, and now, of course, they lost a lot of revenue from both sales tax audits, income tax audits, property tax audits, anything. Excuse me. And so they are really ramping them up and sending them out. So I'm glad to see that a lot of you have not gone through that recently or not currently going through it, and I hope it stays that way. Due diligence. So I touched on this earlier briefly, but this is buy or sell side due diligence. What happens is the buyer or seller will find reasons, right, to, of course, lower or increase the sales amount. Your SOL professional should come in there and say, this isn't entirely accurate, right? So a lot of times we have clients who, like I said, started a SaaS company or started whatever sort of business it is. They are looking to get bought out by some sort of PE firm, whatnot. And so, this firm comes in and says, hey, we had our accountants look at it, and it looks like you have $200,000 worth of old sales tax, right? You've had physical presence here for a while, or you reached economic, so you haven't been filing here, or the income tax returns are wrong, whatever it may be. And so we're going to lower that purchase price, right, by 200K. And I've had clients who are like, I just want this deal done. I'm excited to sell this, and so that's great. Again, it's their decision or your decision to sell your business, of course. But a lot of times we can come in, or you can have your CPA or SOL professional come in and say, well, yes, they owe some liability, but really it's only, you know, 50K, not 100, or excuse me, not 200K. And so you kind of work that negotiation. So again, some things to keep in mind about this whole reviewing of your systems. Okay, and now we are on to refund reviews. So kind of what we were talking about, audits being ramped up. That's part of the reason why they're more important than ever to get this set up. The sales tax and Wayfair rules have been in place for about 5 years now. So we did see a lot of leniency among states when these were first set up. So, you know, you might have had economic nexus for a year. You got a notice, the state says, hey, let's not worry about the year. We just want to get you set up going forward because these are new rules. Those, you don't see that anymore, right? And so along with anything else, the market's doing some things right now that aren't favorable. Interest rates are up. So for all these reasons, money is always precious, but it's important right now. So our favorite thing to do here is this refund review. Again, we're not saying that nasty A word here, but so what is a refund review, right? It's a situation where a business has paid more sales tax than they should have. So everything that we talked about prior is the business as a seller, right? Do they have nexus in these states? Should they be collecting sales tax in these states? Do they need to be filing in these states? Now we're looking at the other side of the coin. Hey, what is your business buying? Are you paying sales tax on what you're buying, right? And so why does it happen that businesses pay sales tax or more sales tax than they should? Can be several reasons. Here we laid out a few of them. So your vendor doesn't know that you're a reseller, right? So if you are purchasing from someone who makes something and you could turn around and resell it, maybe they don't know that you're going to turn around and resell it. You haven't given them an exemption certificate, right? So it is their duty, right, to collect sales tax in states they have nexus on. That's all they know. I have nexus with the state. I'm selling to a company in that state. I need to collect sales tax on that state. They're going to do that unless you give them a reason not to. So maybe your vendor doesn't know that you're a reseller. And so they charge you sales tax when you pay it. Maybe your vendor doesn't know that you are using the product in an exempt manner. Laid out a few examples here: manufacturing, agricultural, R&D. So let's say that you are a manufacturer of some sort. As we talked about earlier, hey, maybe we're not worried about collecting sales tax, but what about the sales tax that you're paying? Manufacturers, equipment, ingredients, anything that you're buying, materials to run your business that go into your manufacturing process, a lot of times those can be purchase exempt, so no sales tax. But hey, your vendor doesn't know. Maybe you're the t-shirt company that I talked about before and you need cotton or silk or a machine to make, you know, weave it. I don't run a t-shirt business, clearly, but you need those products to make your shirts. So, you know, whoever is selling that cotton is just charging you sales tax because it's a taxable item unless you say otherwise. So you are just paying that sales tax and making your products. And so they don't know you're using it in an exempt manner. I put agricultural on here too because, you know, we see a lot of big purchases. Sometimes the tractors used during agricultural work can be exempt. Drip lines, seedlings, all sorts of stuff that can really add up to a lot of money, even like animal feed. So a lot of stuff like that can be purchase exempt. R&D, you know, R&D obviously has a lot more, it's a lot wider than most people think of when they hear R&D. So any sort of thing that you're changing inside your business could be considered R&D. Again, that's an oversimplification. We had a client who needed, so this particular client was exactly what you think of when it was R&D. They needed a clean room to test some materials, some health materials. So anything that they use to buy for that clean room to do R&D, all of that's going to be exempt. So a lot of stuff can be bought exempt. Your vendor doesn't know what you're doing unless you tell them, right? Another reason is they don't know what to charge tax on. Do I charge tax on the installation of a product that I'm selling you? Do I charge tax on the shipping price that I'm selling you? I put SaaS on there because it's taxable in about 20 states. Sometimes we see, for instance, Arizona is a state that charges tax on SaaS. California next door does not charge tax on SaaS. And so perhaps we have a SaaS company in Arizona that says, hey, I know that SaaS is taxable. And they live in their world. They know that SaaS is taxable in Arizona. So they think if they're selling their service or product outside of Arizona, then everything needs to be taxable. But it's not the case. So if you had that California situation I was talking about, they didn't need to pay sales tax on that purchase of SaaS. And then the tax rate changed, right? I mentioned this earlier. We had a client who they'd been doing business with someone for about a dozen years. And a dozen years ago, the invoicing system was set up. And I think at the time it was 9.3%. 6 years later, it changed to 8.3%. They didn't change their invoicing system. So for 6 years, they were paying an extra 1%, which, you know, doesn't sound like a lot right now, but, you know, added up over 6 years and hundreds of thousands of dollars of purchases, it does become a lot. So your vendor might not keep track of all this. The vendor doesn't know what you're doing. So this happens quite often. And then, like I said, maybe we need to look inward into our businesses, right? We just need the machinery, the equipment, the materials that we need to run our business. And so we have our accounts payable, or we're signing off on invoices, and we're just saying, give us the stuff so that we can produce our product or do what we need to do without actually looking at the invoice and taking a step back. So all these different reasons could be why a refund review would be really great. So it says the vendor can ask the state for a refund. It really should say the business can ask the state for a refund. Newsflash, the state is not going to say, hey, it looks like you paid 1 extra percent and you gave it to us. Here's this money back. That's not going to happen. And so you'll need to you need to start this process yourself, or have someone like Leighton or your CPA do this for you. So, but it's a straight refund. It goes straight to your pocket. And so it's really, really helpful. So that is refund reviews in a nutshell. Here's a quick case study. I think we might have 2 of them, but this was a manufacturing company like I talked about. They didn't have someone reviewing their invoices. They spent a lot of stuff. It was a heavy manufacturing facility. And so that was about $1 million. And again, we did a quick benefit study to see how much money we get back. And they ended up getting $120,000 of sales tax back straight to their pocket. I have had big reseller stores. We found one invoice that had 150 grand of sales tax on it, straight back to their pocket. They didn't need to pay it. So it's going to be really, really helpful. Here's another example. Retailer started Nexus study. Again, this is the one I was talking about where they had the wrong tax rate. So you can see there, we got 250K back from. So really awesome stuff. I think, yes, this is going to wrap up the sales tax portion. I know we're getting close here, so I'm going to fly through the other stuff. Ask Maggie, I'm going to give you the last, or one of the last questions here, polling questions.
Thank you. All right, you guys, it's about to launch, but here it is, it's launched. Have you had an income tax apportment / nexus study alongside sales tax? You have to pick one answer. The answer could be yes, I did both, or always prepare both for clients.
True and false, right? Yeah.
Or no, I didn't know I should, or don't prepare for clients. Get your polls in. All right, you guys, we've got most that are choosing no. It's almost a perfect split. 80-20.
All right, as she mentioned, this is poll number 3 out of 4. We'll give it a couple more seconds here. And getting ready to close this one down in 3, 2, and 1, with the majority at 78% saying no. Back to you.
And please keep putting your questions in the chat box. We'll send you guys emails with the answers.
Awesome.
Because we are running low on time. There's just too much to talk about when it comes to salt.
There's a lot going on in salt, that's right. All right, so 80-20, so that makes sense to me. So, and this is an experience I had at, again, I was at Big 4 and top 10 CPA firms, but you know, a lot of times what happens is client or business says to their CPA, hey, this is my sales numbers and this is where I sold them to, and go file the returns for me. And the CPA, again, no, this is not a shot at any of my CPA brethren, but a lot of times they say, okay, great, we've got a lot of returns to file by 3/15, 4/15, 9/15, 10/15, and so they start filing. My job was always to come in and say, hold on, let's look at where we really should be filing. Let's look at some sourcing rules, all of that. So this is, in my opinion, should go hand in hand with a sales tax nexus. So it operates very similarly with a couple exceptions. We'll talk about that here. South Dakota and Wyoming, those are the only states that don't have an income or a gross receipts tax. There are other states that don't have a corporate income tax, but there are some sort of other tax that you need to worry about. And so just because you say, oh, there's no income tax, doesn't mean you need to not worry about the other type of taxes. Nexus. So there are three different types of nexus considerations, or how the states set it up for income tax. There's the bright line. For example, California is 690,000 of sales, 69 of payroll, 69 of property. So California says, hey, if you're reaching one of these numbers, you're considered to be doing business in our state, therefore you should be filing an income tax return in our state. There's the multi-state tax commission, the MTC. They say 550/50 is a good rule of thumb. The MTC is not a governing body, by the way. It is a suggestive body, and a lot of states look to them for guidance. But again, that's just that. It's just guidance, not anything that's governing. And then we have kind of the last situation where we see in most of the states say, hey, if you're doing business or you're deriving income in our state, then you need to file an income tax return, right? So super broadly written. It's done on purpose for states in the case that they want to audit you. And then they say, hey, it looks like you're doing business in our state, right? So these operate similarly to the sales tax nexus rules, with one caveat. There's that word again, is that this public law 86-272 comes into play, right? So that is what I said on the agenda. We'll get back to it. So this is a law from 1959. It still does apply. It has been chiseled away quite a bit. So what this law says is more or less that states cannot enforce an income tax upon your business if you're only doing certain things. And those certain things are, first bullet point, you're only selling tangible personal property, so widgets, shirts, anything tangible, as opposed to services, which this does not cover. If you're in the state, all you're doing is solicitation. If you're shipping to a state, all you're using is common carrier, again, not your own trucks. And if you are only doing those certain things, then you're not forced to file an income tax return here. I will say a lot of the states will want you to file an income tax return and just check a box or write on there somewhere on their return that says, hey, we're protected under public law 86-272. So keep that in mind. And then there was this new MTC guidance that came out last summer or 2 summers ago that said all these different web-based activities, we're going to say that gives you, you should be filing, that they're not covered by PL 86-272. So the e-chats that we see now, right? You're going to a website to buy a product. There's a little box that pops up in the corner and says, hey, I'm Brian. What can I help you find, or anything like that? Now, that says, hey, you're putting some sort of physical presence on that computer in whatever state that person is in. Same thing with applications, warranties, cookies. So a lot of these types of activities are not protected by 86-272. So there is that caveat, but it's very narrowly defined. And then there comes to sourcing and throw out and throwback rules. I'm going to run through this quick. It can be very confusing, but we're running short on time. So for sourcing of tangible personal property, that is sourced just like you would see in sales tax, anything else. Wherever that property is shipped, that is the state that it should be considered to be the revenue is received. If you have some sort of service business, there is a difference between cost of performance states and market-based sourcing states. So as you can see there, cost of performance says, hey, we source revenue based on where the work was done. Market-based sourcing says we source revenue based on where the benefit was received. The classic example I like to use is some sort of service business in Arizona. And I pointed out because that's where I'm from and it has a bunch of funky rules, but generally speaking, it's a cost of performance state currently. Texas is another one, which is big. But if you're doing work in in Arizona and you're selling your service, whatever it is, to a resident in California, Arizona will say, hey, the work was done in Arizona. It needs to be on an Arizona income tax return. California says the benefit was received to a client in California. It needs to be on a California income tax return. So you get this situation where on the right side there on the slide, you can see this double tax, right? Both states want to tax this. And you can imagine a situation where the role is reversed, right? We have clients who are fortunate enough to have individuals based in different states, and we can shift work around. And so, hey, let's do the work in California, sell it to an Arizona customer. Now neither state can claim that income tax. So there are some things that you can do here to, again, really help on savings of taxes and to take advantage of these rules. Business taxes, again, I'm flying through these guys, I apologize. So these are not protected by the 86272. So Washington business occupation, Nevada commerce, Ohio commercial activity tax. Probably heard a lot of these, but these are in lieu of or in addition to income tax. So if you have all these sales here and it's just property and you're only doing solicitation, doesn't matter, right? You still need to pay this Washington business and occupation tax. So something to keep in mind. Also consider the nexus liabilities reviews, right? So it should be sales tax, it should be income tax, it should be these, what I like to call business taxes.
Brian?
Yes.
I'm so sorry to jump in, but we are just about out of time and I need to launch one more poll.
Yeah, launch the poll, please.
All right, while I have that open, you may continue to speak.
Okay. Yeah, and I think the poll is just kind of what drew you to the meeting today. So hopefully you can answer that. I just wanted to talk about property tax and credits incentives real quick. So property tax, and this is a fun fact, makes up 39% of state revenue. A lot of people think of sales tax and income tax as a big part. It's actually property tax. So it's important to get those filed. They're administered by local tax jurisdictions, not the state tax, not the state jurisdiction. And they're just like a income tax return. They need to be filed every year. Real property, personal property, right? So even like furniture, computers, inventory that you're holding to sell, depending on the state, you might have to pay some property tax on that. And then the final slide here is credits and incentives. Each state has their own program. So this is not a, there's a little landmark there. It looks like it's on DC. This is not out of DC, right? It should be an X over DC. Every state has their own program. I used to joke, hey, if your client or your business is doing anything at all, we should talk about credits and incentives, because if you are hiring new people, you might get some payroll incentives. If you are building new facilities, if you're training, right? If you want to do some new managerial training and you hire an outside source to come in, you might have some sort of income tax credit or payroll tax credit. So a lot we can do with SALT. I ran so much information by you guys. I appreciate you being here. And I hope to see some of your questions, answer some of your questions after this.
Well,
thank you, Autumn. I don't know. Yeah, there's some emails. So
yes,
thank you guys so much.
Thank you, everyone.
We've dropped in links to book meetings with us. If you guys want more information, we'll email you the answers to all your questions. And hope to hear from you guys.
I was gonna say I lost my dog midway, but if you need some cute puppy pictures, we can supply those too.
Thank you so much. Just want to remind everyone that the handouts, the archive of the webinar, and your credit will be available in your CPA Academy account within 24 hours. And if you look in your email inbox, you will find the evaluation link for this webinar. As we mentioned, all questions asked today will be forwarded in a full report to our presenters as well. And I've seen a lot of great comments coming in. Thank you so much for that. Please check the schedule on our website for additional information, and we hope to see you on a future webinar. Have a great day, everyone.
Thank you.